Currency pairs and their characteristics. Forex is the world's largest interbank currency exchange market. Its daily financial turnover exceeds $5 trillion. Forex is a global network of sellers and buyers, with brokers acting as intermediaries in between. One can deal in any currencies through brokers. The most common currencies for trading are the US dollar, euro, Japanese yen, British pound, Australian dollar, Swiss franc, and Canadian dollar. All currencies are traded in pairs. The largest volume of deals comes from foreign exchange transactions in major currency pairs that include the US dollar. Each currency pair has distinctive characteristics, so it is crucial for a trader to know and understand the factors that influence exchange rate dynamics. Euro and US dollar. This is the most liquid currency pair in the world. Bets on this instrument account for almost 29% of the whole daily trading volume on Forex. Around 70% of all traders work with the euro-dollar pair. The instrument demonstrates considerable activity during intraday sessions, coupled with moderate market volatility. Any upbeat news from the US pushes the euro lower, and vice versa. It is very important to keep track of the ECB's policy and follow all remarks made by its president Mario Draghi. As for the United States, a trader should focus on actions of the Federal Reserve and statements delivered by Fed Chair Janet Yellen. The best time to trade this currency pair is from the open of the European session through New York deals to the close of the US session. The highest liquidity can be seen when trading hours of the two sessions overlap, from 1 p.m. to 5 p.m. GMT. US dollar and Swiss franc. According to the Bank for International Settlements, trading in the dollar-franc pair makes up roughly 5% of the total foreign exchange daily volume. The main peculiarity of this currency pair is that it is negatively correlated to the euro-dollar pair. The Swiss franc has low liquidity, so sharp swings and chaotic movements are not typical of this major. Compared to other currencies, the Swiss franc is viewed as a safe haven asset. Amid geopolitical disturbances, a large bulk of capital flows to Switzerland. The Swiss currency also displays a close correlation with gold, as the franc is one of the few currencies that are partially backed by gold. Whenever the precious metal surges, the dollar-franc pair drops. The pair is influenced primarily by the economic situation in the United States rather than events in Switzerland. Therefore, those who trade this pair should focus on the price action of the US dollar against other currencies. The currency market sees the most active trading periods in this pair during the New York session, while the quietest time is during Asian deals. Being moderately active and relatively predictable, the dollar-franc pair is perfect for trading beginners. British pound and US dollar. This is a very popular trading instrument in Europe, especially in the United Kingdom. This major currency pair is nicknamed the cable. The pound-dollar is the third most traded currency pair in the world. It generates 12% of the daily trading volume in the foreign exchange market. The pair is extremely volatile and known for its erratic and uncontrollable movements. Average daily fluctuations in this currency pair reach up to 130 pips. That is why the pound-dollar pair is often chosen for scalping. The exchange rate of the pound sterling is affected by both domestic economic and political developments and news from the Eurozone. The pound's movement frequently correlates with the exchange rate of the euro. The British pound is one of the most unpredictable currencies, as its dynamic is very hard to forecast, so trading novices are not recommended to start with this pair. The pound-dollar pair is notorious for false support and resistance breakouts, which should be taken into account when making trading decisions. US dollar and Japanese yen. This currency pair is most actively traded during the Asian session. Its daily turnover constitutes 13% of the overall trade volume. This is the second leader in terms of volume among all currency pairs. The dollar-yen pair reacts strongly and quickly to the global stock market dynamics, as well as the macroeconomic releases and political events. Sharp swings of the exchange rate may lead either to huge profits or heavy losses. Therefore, this pair is advised only for experienced traders. Because the Bank of Japan's benchmark interest rate is very low, the yen currency pairs are popular among investors interested in putting on carry trades. The dollar-yen currency pair tends to respond in a swift manner to escalating risks in financial markets. In such cases, the yen typically strengthens against other currencies. This happens because investors close their carry trades. Japan is an export-driven economy, so the Japanese Central Bank and Ministry of Finance, which benefit from the weaker yen, may often intervene in the foreign exchange market. To sum up, every currency pair has its own peculiar characteristics and typical behavior. Each currency is exposed to a number of price-driving factors and downside risks. Therefore, it is a must for traders to grasp all of these features and take them into account when trading in the international currency market.